It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show, and I'll tell you what, today I really want to talk about some of the common misconceptions that I often hear regarding your personal bank and the whole concept and, how it works and that type of thing. I've had the pleasure, actually, I've been speaking to a number of folks who've been reaching out to me, a lot of folks from Money Radio. I had one gentleman talk to yesterday, actually. He says, I was just driving around, was flipping dials and happened to hear your voice, and you mentioned the personal bank, and I'd actually been looking into this idea through someone else recently, and anyway, it caught my attention. And I'm like, well, that's awesome. That's really what this is about. Educating people, introducing them to a concept that, frankly, most people are not familiar with based on, all the folks I talk to. Or even if they have been, like this gentleman had been introduced to the idea, not fully talking to somebody who wasn't able to fully, flesh out the details and help them really understand it, if you know what I mean. The reality is the personal bank concept is quite simple. It's not complicated, which, by the way, is probably my first misconception I kind of want to dispel. Some people, it's kind of human nature out there, and I think I talked about this on last week's show, that the number one, response or question or whatever I get when somebody first starts seriously taking a look into this is, why haven't I heard about this sooner? And there's a lot of reasons behind it. Probably one of the main reasons is most people, including advisors, like I said earlier, are just not familiar, have never been really introduced or looked into this concept that much. This is used, it's not new. I mean, that's one of the common misconceptions. Just because you haven't heard about something doesn't mean it's not real or effective or something worth considering, because this has been around for decades and decades, as I point out all the time. Bank boards, corporate finance boards, wealthy individuals, family offices, those types of entities commonly use this tool or use this financial concept. And so financial advisors and folks that deal in those arenas are quite familiar with this. Those that don't typically are not. And obviously that's a very tiny percentage. I mean, most financial advisors, frankly, their focus isn't dealing with, banks or corporate finance boards or, family offices and things, institutional investing is kind of the institutional world. There's some out there that deal with that, but in the overall context of if you take the whole gamut of all the financial advisors that exist out there, it's a very tiny percentage. So just from a standpoint of what does last week's show I was talking about it, and if you didn't hear it, I was talking about what's your financial advisor's area of specialty or expertise. One of the most important questions you probably could ask any advisor, again, whether they're a financial advisor or tax advisor or legal advisor, whatever. And if you missed that, I'm going to encourage you to go to yourpersonalbank.com, listen to last week's shows. In fact, you can listen to any of the previous shows on there. Again, yourpersonalbank.com. Highly encourage you to do so. But the thing is, again, it's just it's more of it's an area of ignorance, and I mean ignorance in the positive term. And I was just not aware of it. It's just something you're not aware of. In fact, in my own personal situation, as I've shared often, I've been in the financial world over 22 years. I've been an entrepreneur. I've actually started 3 businesses, bought my original business, a retail store. So I've owned a retail business, a contracting company. I started a service company. Of course, the Secure Statement, our company, our financial agency, I started 16 years ago now, and in the process of starting a bank. And so I've been an entrepreneur basically my entire adult life, pretty much right out of college. And before that, I did the military and stuff like that. So I was one of those late bloomers, I guess. I was, I was going to be just without, throwing a lot of detail, boring people. But, in high school, I was going to be a veterinarian, actually. Grew up on a farm in Missouri and had taken all the classes, basically had the grades and everything to be accepted into pre-med or pre-vet school. And had a major epiphany change in my life. My senior year, realized I didn't want to go that direction. And so I was kind of lost. I'd taken all these science courses and all these, geared up, ultimately to become a veterinarian. And all of a sudden my whole life changed my whole focus. I didn't really know what to do. I was also a musician. I, did all conference, all state, all this kind of stuff, playing trombone and things, and I was, fairly good at it. And a group through the U.S. Army came through our high school, and I was introduced to them. Decided to audition for that group. Got to travel around the country. It was a really fun duty for me to do, and I was part of the Old Guard. The U.S. I was in the Fife and Drum Corps in the Old Guard. We performed at the White House and literally all over the country, all types of different events. So it was a very interesting and fun thing to do as a young adult. Expanded my horizons, if you will, because prior to that I was a Midwest farm boy and hadn't traveled very much, so I hadn't really seen the world yet. So that really opened my eyes up to a lot of things, which was a great experience. Then I went to college, of course, got my bachelor's degree, went to work for the U.S. government, determined that was not for me, and shortly thereafter, actually, I read a book. I was thinking about becoming an entrepreneur, starting a business. And I had read a book, I can't even remember what the book is today, that said, look, if you purchase an existing business, one of the advantages is you have immediate cash flow. So it made a lot of sense to me. Found a older gentleman looking to retire from his business he had started and purchased it, and that was my first retail business. Went really well for about 3 years. Gulf War hit, so the economy took a dive, and I was just not prepared for that, frankly. The thing is, I had a consultant by that point who told me I got my master's in business administration from that experience. So, sometimes learning from the school of hard knocks really does, you don't forget those lessons. I'll tell you that much. But anyway, I kind of got off on a tangent there, and I do apologize because I was really wanting to focus on, the personal bank and the misconceptions out there. But again, I've been in the financial industry quite a while. Like I said, over 22 years now. Been an entrepreneur close to 30 years now. It's hard to believe. So it gives me a perspective. My wife calls me a Renaissance man. It gives me kind of a fairly unique perspective in terms of business and money and how things really work. I've had employees. I've not had employees. I've been done W-2, 1099, all those various different methods of getting paid. So I understand how all that works and learned a lot of those things along the way. Of course, had mentors along the way, still do. And that's kind of where a lot of this comes from. And so when I was introduced to and I had not, I guess my point I'm trying to get at is I had not been introduced to the personal bank concept myself. As a financial advisor, in fact, I was one of the leading advisors in the country in terms of the annuity world. Top 10 in the country with one or two of the top annuity producers in the country, multiple years. So I wasn't a slacker, if you know what I'm trying to say. We did a lot of the workshops and dinners and all those kinds of things. And we're dealing primarily with the retiree or nearing retirement community folks and great folks to work with. So the focus was to preserve capital and create guaranteed income and some tax deferrals, things like that. The thing is, through all that, because my focus was in that arena, I had not been introduced to the personal bank concept, using cash value life. In fact, myself, just as a personal experience, I used to get asked, should I get life insurance? Should I have life insurance? And for years, I would say, in most cases, for folks that were older, nearing retirement or in retirement, that was not necessary because they had enough cash available, whatever, to cover expenses and various things, right? What I didn't know at the time, and so this is, again, a personal experience, and what a lot of financial advisors and folks out there don't know is some of the strengths and what the contract, the policies can do. In other words, there's certainly tax benefits. You can create tax-free income. I was frankly unaware of that. I was a licensed insurance agent. I should have known those things, but the reality is most don't really understand how all that works. And why that's the case is I saw some studies on it not too long ago and showed that of licensed insurance agents out there, something like only 10% had ever submitted a life insurance application in their career. In other words, most of them dealt with annuities and those types of things, the vast majority. We're going to talk about more in the next segment about why folks, the advisors we talk to and people we talk to are not familiar with this concept, and also why you should consider looking into it. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Well, welcome back. Last segment, we were talking a little bit about, I got into a bit of my personal story, so if you want to hear a little bit more about my experiences, check it out on yourpersonalbank.com. You can go back and listen to it, like you can go back and listen to any of the previous shows. But my point I was trying to get at, really what I'm wanting to focus on here is some of the misconceptions about the Your Personal Bank concept, and one of them is probably the biggest I run into most frequent, is, when people start looking into it, they're like, wow, this does more than I thought. I'm interested. I'm more interested than I thought I would be. And why I haven't heard about this before? I mean, if this is so good and that type of thing. And again, there's a lot of reasons why, your advisor hasn't talked to you about it or you weren't into it. A lot of us as advisors, financial folks, we're just not introduced to this concept. It's not part of the normal course of things we run into. As I was sharing on the last segment, I've been in the financial world 22 plus years now. And so for the first, 14 of them, something like that, 14, 15 years, I was not introduced to this concept at all. And I was one of the top annuity producers in the country, like top 10 in the country with some of the top one or two companies in the country. So I'm not saying that to brag. I'm just saying, I wasn't a slacker. I was out there doing a lot of business, went to a lot of ongoing training, continuing education credit stuff. I mean, all of it. And this was a concept that I never, frankly, crossed paths with. And part of it was because of the clientele I was working with. I was dealing with a lot of folks who were nearing retirement or retirees. Average Americans. Yes, I obviously still do have some very wealthy clients. But the vast majority are just normal everyday folks, if you know what I mean. So I would be, dealing with what you would consider the biggest cross section of American, average American folks, right? Like I'd say most advisors deal with that, obviously. So this concept was never brought to my attention, and even I'm ashamed to say almost, I didn't know any better at the time, but I would get asked a lot of times, I've been looking at life insurance, should I consider it? And almost universally, I was one of those that would say repeatedly, no, your financial situation's fine. You have enough money to handle emergencies and various things. You don't need any life insurance. What I didn't realize at the time, and I do now, is all the different things that the personal bank concept can do. And it's not just the insurance tool. It's part of it, okay? But when you put that together, remember what we're doing. We're putting a high cash value insurance policy. These are tools, been paying 6% dividends. I can show you companies that have been paying 6% dividends every year for the last 25 years in a row. I can show you companies that have been paying dividends every year since before the Civil War, literally, and never missed. Okay, so these are huge, long-term, strong dividend-paying companies. In fact, and I was myself unaware that there were companies out there that paid these kind of dividends and had so consistently for so long. In fact, one of my clients, or a friend of mine, actually, he reached out to me a couple of weeks ago. He was listening to one of the shows, and he even said to me, I had no idea there were companies that, were paying 6%, still paying 6% today, plus had done so for so long. I said, you and me both. For many years, I was unaware of that. It's kind of funny. They go along doing their business so quietly. I wish they would trumpet. I wish these companies would, broadcast this kind of information more. They're conservative, long-term, a lot of them out of the Midwest type of companies that are just, they don't like to blow their own horn, which I think sometimes to their detriment. It certainly is it's a different perspective from Wall Street. Wall Street is, the perception and a lot of it's very accurate, brash, loud, that kind of thing, blow their own horn very, very, very commonly. It's a different mindset. And it's a different, so that's why we don't hear about it so much. But the facts are, there's companies out there, A-plus rated, tremendous cash reserves, paying 6% even today, dividends consistently, have done so for over 25 years. I'll show you the charts. I'll show you the charts of what companies have paid what every year for the past 25 years. That's pretty awesome. And so my point is, one is if somebody's looking for a safe, guaranteed, tax-free type of income with nice returns, nice, steady, consistent returns, this is hard to beat. This is the granddaddy of them all, if you will, in terms of consistent, steady dividends, income type producing asset. So that's one thing. So a lot of these folks, I'm sad to say, that asked me, a decade or more ago about should I get life insurance. If I had known about this tool at the time, I would have said to them, you should consider it, because a lot of those folks I was talking to, obviously they were, they were interested in looking into annuities, for example, for income and stuff. This would have been a very, very good solution for many of them. Probably preferable to the annuities because, annuities do grow tax deferred. That's true, but tax free is still better, isn't it? So that's one thing. Secondly, I find another thing why this tool can be such a benefit in terms of a tool used for those folks that are nearing retirement. And that's another common misconception, by the way. A lot of people say, well, I'm 60s or whatever. I'm too old, to qualify for this, Well, actually, you're not. We've had cases where literally we've had folks up to age 79 successfully fund these, and the numbers worked and it made sense. So granted, the 79-year-old was average health. I mean, if you got really bad health, okay, or age could impact it. But the thing is, you don't necessarily have to own it. You can actually have someone else be the insured. So typically like a family member, a business associate, that type of thing. The owner controls the money. They get the benefit of the growth of the money and all that kind of good stuff. The tax benefits, all those kind of things. So it still works. So it's not the end of the road. So that's another misconception. One is, why haven't I heard about it? Well, I've shared a little bit of my own personal story. I didn't hear about it for the first, 14 years or so of my financial career. I've been dealing with it for the last 7 or 8 years. Once I was introduced to this, I was like, oh my gosh, holy cow. It was a major epiphany, okay? And it literally, and it took about 6 months, actually almost a year of really diving into it, learning it, understanding it to the point where I could start really sharing it with others. And it changed our entire business model. A lot of people call our company a 2.0 version. And it's true, because what we do today, do we still do annuities and some other things? Yes, but that's very much secondary to what we do today. Most often we're presenting and introducing the personal bank concept and all the things it can do in terms of growing your money, getting tax benefits, and having access to your money and still picking up positive arbitrage. See, this is the game changer. The game changer is bringing in, and that's another question I get all the time is, well, is this like the insurance banking concept, or it's known by a number of other names? And I said, yes, there's definitely similarities, but we've taken it to another level. And that's the comments I've been getting a lot from folks is, by bringing in the bank line of credit, what we're doing is we're genuinely creating positive arbitrage on your money when you spend it. See, folks, this is the difference. This is the big game changer in terms of how this tool works, this concept works, versus pretty much any other financial concept or tool out there. See, any other financial account, we all know that once you spend the money, once you use the dollars, those dollars are gone forever, right? You use them to pay bills, supplement retirement, invested elsewhere. The reality is the money in that account, once you've allocated it, used it, spent it, the return on those dollars becomes zero. You stop making money on it because what happened? Well, you spent it, right? You used it for other purposes. The personal bank concept, by using the high cash value policy, like I said, companies paying 6% dividends plus the last 25 years plus. I say this to people all the time. You put the money in the account, you're going to get credited the 6% dividends and leave it alone. If you access it through the bank line of credit, and the bank lines right now are charging between 3 and 3.95, so in the threes, if your money is getting credited 6 and you access it and you're getting charged 3, for example, what's your money doing? You see, it's pretty obvious. It's pretty clear. Your money's still working for you, still growing. You're still making 2 to 3% return on monies that you actually spent and used elsewhere. That's the key. We're going to touch on that more in the next segment, so don't miss it. Stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. back to the Your Personal Bank Show with Ference Toth.
Welcome back. Today we're talking about some of the common misconceptions about the Your Personal Bank concept. And like I said in the previous segments, the first one is, why haven't I heard about this before? Why did my advisor introduce me to it? And again, there's a lot of reasons behind it, but the main one probably is that, the advisor just wasn't introduced to it themselves. This is a very specialized area of the financial world. I like I said myself, I was one of the top annuity producers in the country multiple years in a row. So one of the top 10 with some of the largest companies in the country. I wasn't a slacker. I was out there dealing with lots of clients and doing a lot of business. And I was not introduced to this upwards of about 14 years. Okay, and I was dealing with financial stuff on a daily basis. So again, unless you're introduced to this area, this world where, again, it's, where corporate finance boards or bank boards or family offices reside, that a lot of that institutional investing type of things, unless you're dealing with that world, and most of us don't, most advisors don't, frankly, most people don't, you're just probably not going to be introduced to this idea in general. It's very common in those areas. And so that's the biggest one. The other one is I get, I'm too old or whatever. I'm in my 60s or 70s even, and I can't qualify for the life insurance. Well, actually, that is a misconception. We have cases, again, successfully up through age 79, by the way, where the numbers made sense. They worked. The cash growth, the tax-free benefits, the positive arbitrage was a good fit for those clients. So just because you happen to be in your 60s or 70s, I would say to you, I would still recommend consider it, because another part of it too is built into these products are living benefits. We don't talk about those a lot. Some people do. And living benefits are really an area where if you have a critical or chronic illness or long-term care type of situation, there's monies available for that, and there's no additional cost to you. When you set up one of these policies, again, we're designing to maximize cash growth. We talk about that all the time, and we talk about the 6% dividends. It's been paid 25 years plus, never missed a dividend since before the Civil War. So again, long-term, strong dividend-paying companies. We talk about that all the time. But by the way, built into it, there is a death benefit associated, which is, even though we're maximizing cash, there's still a death benefit there that's much larger than the amount of cash you've contributed in most cases. So typically what happens is, roughly half or so of that death benefit would be available if you ended up in those critical, chronic, terminal illness situations or long-term care, whatever it may be. Those monies are available. And it's tax-free. It's an advance on your death benefit. And there's no additional cost for that. So one of the things I comment on all the time is, look, if you end up with a medical situation, long-term care situation, whatever, and you need the money, it's there. And if you don't, you didn't pay for it. So really, what could be better than that? It's a very good strong point. The other one that I run into, what people often overlook or don't think about is, again, we're focusing on maximizing cash growth. Totally get that. Totally understand that. And we spend most of our time on that with most clients. But again, because there is a death benefit associated, and when I'm particularly dealing with couples, and particularly couples who are nearing retirement or are retired, often both parties are receiving Social Security, sometimes other income sources, pensions or whatever. And if one did pass away prematurely, of course, those incomes would stop. Social Security would be reduced or stopped. The pension could be reduced or stopped, those kinds of things. Having that death benefit there in place by doing a his and hers, I say, well, let's do a his and hers, get you both qualified. And that way, if something happens to either of you, you've got the medical, the critical, chronic, terminal benefits, you've got the long-term care, all that covered, reciprocal, right? Or you got a good portion of it covered, and no additional cost to you. But there's also that death benefit that could be paid out in case something happens to either party, which can offset a lot of lost income, Social Security income, or those kinds of things. So it can go a long ways to replacing lost income if something happens prematurely. So it's nice to know that those things are there. And that's why somebody who's maybe a little bit older, okay, seriously considers and looks into this, because there's additional benefits over and above just the return on your money or getting the dividends, right? And remember, we can get the 6% dividends on these contracts tax-free. That's not bad. We can also do the index options. I don't talk about that as much, but we have the index option where it's based on the S&P 500, and you get a 1% floor and a 14% cap. In other words, it's pretty simple. So again, some people try to make it more complicated than it is. It's really not that complicated. You're going to get between 1 and 14%, depending on whatever the S&P does that year. So if it goes down, you get 1%. If it goes up, you get 15, you get 14. It's that simple, okay? And each year those gains are locked in. So it's kind of nice way of getting some nice gains without the downside losses. The average annual return on that particular product happens to be 8.52% the past 25 years. That's not a bad return when you also consider that's tax-free and the downside's guaranteed. So when you put 8.5% out there, history, tax-free with downside guarantees, that becomes very appealing and very strong. And then you also have the long-term care, critical, chronic benefits, and a death benefit, tax-free if something happens. You put that whole package together, that gets very, very appealing for a lot of folks. And it's a great fit for a lot of folks. But then don't forget, we've taken the personal bank concept to another level. And what I mean by that is by adding the bank line of credit to the whole package, now what we've done is, look, when you access funds from this, you don't access them from the policy. You don't take withdrawals or policy loans from the actual policy. You take them from the bank line of credit. Why? Well, for one, if using the fixed option, if you're making 6%, let's say, dividends, and then you access it and the bank charges you 3 to 3.95, what's happening to your money? You're still making money on dollars you spent. Okay, that's not available pretty much across the board anywhere else. You spend money, it's gone, right? Here you can actually spend money, use it to supplement retirement or do whatever you want, and you still have a return on your money. You're still making 2 or 3%. You're making the difference. You keep the difference, right? So again, when you put all that together, that's why you can see why somebody who's maybe a little bit older or retired or that type of thing, who initially would say, well, that sounds great, but I don't qualify for the life insurance and the numbers won't make so much sense. Actually, they do. In many, many cases, most often, frankly, they do. So, and again, even if you were in a situation where age or health-wise did not allow you to qualify or there was cost prohibitive, that's not the end of the road. We can insure somebody who's like a family member who's younger and healthier, business associate, those kinds of things. You still own it. You still get the benefits, the growth, the tax benefits, all that good stuff. They're just the insured, so the numbers work. Okay, so we can make it work for you that way too. And that takes care of another one of the, probably one of the most common misconceptions. I'm too old or not healthy enough. Well, that doesn't matter. We can still make it work, okay, and work very well for you. Again, I already covered, a lot about why I even heard about it. Just frankly, again, it's most people, most advisors have just not been in the arena in an institutional investor world just to be even introduced to the idea, much less look into it. Okay, so those are a couple of the most common misconceptions. The third one I want to touch on, and we're going to probably hit that more in the next segment, is, and this one probably is near and dear to a lot of money radio listeners. We talk a lot about the fixed 6% dividends. It's been paying the last 25 years, which is strong. 6% tax free, I think most people agree is pretty good these days. But what if you want a bigger, higher potential upside? And like I said, the index options. And one of my new clients was talking to somebody. I spoke to him just yesterday, in fact. And he was like, I have a question. We set this up, and, I understand, and I've got the 6%. It's been paying 6% dividend. Expect to, get something like that strong. It has for the last 25 years. But why didn't we go with an index option? That was the question that the other advisor, who had some understanding of the personal bank concept, which is good because the idea is getting out there a little more. He's like, why didn't you use the index? And we discussed the reason why we chose the guaranteed option with him. And after we discussed it further, he completely agreed. We're going to talk about that a little bit more, about maybe why you should look at the index versus the fixed or vice versa in the next segment. So make sure you stay tuned and don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third, and we've been talking a lot today about the common misconceptions regarding your personal bank concept. Now, remember, what is your personal bank concept? It's actually quite simple, and that's the first common misconception. It's human nature. If somebody's not familiar with something or don't understand something, it's not uncommon that they'll just dismiss something as that's too complicated. And frankly, it's because they don't understand it, don't realize what it can do, and for whatever reason, they're either in their comfort zone or they just don't have the desire or whatever to learn about something else. Okay? It's not complicated. It's actually quite simple, and I can say that very strongly because if you ever read a mutual fund prospectus, they could run into several hundred pages, okay? I think from a definition of complexity, that sounds pretty complicated. But the reality is this, it's really quite simple, and that is that you're setting up a high cash value insurance policy. These are not the type of policies most people are familiar with. These are designed to grow cash and minimize the death benefit, which is the opposite focus for most people using life insurance, okay? So we're doing the opposite. This is the focus that, institutional investors, banks, corporate finance board, family offices often use. It's very common in that world, which is another one of the common misconceptions. Why I haven't heard about this? Well, if your advisor, you haven't dealt with those kind of institutional investor worlds, you've probably not been introduced to this idea. And that's why we're doing the show, to make it more. It's not that it's a big secret. It's just not commonly shared. And so I was fortunate to come across it, started using it myself, started sharing it with our clients 7 or 8 years ago. It's gone gangbusters, and we just have done workshops, traveled around the country speaking on this and educating people, which then led to the radio show, a bigger audience, a bigger platform to share with more people. That's all, because this concept can make so much sense for so many people if they just don't know about it, or they haven't really looked into it, or they don't know anybody who can educate them about it. So that's kind of one of the misconceptions. And back to the simplicity part, it's a high cash value policy. Like I said, designed to grow cash. We have companies that paid 6% dividends, 25 years plus, never missed a dividend since before the Civil War. Strong dividend, long-term dividend paying companies, A+ rated, all kinds of cash reserves, the whole thing. So your money's growing. You're getting consistent growth, steady, consistent growth, downside guarantees, tax-free, all that's good stuff. Then we combine the bank line of credit where when you want to access the funds from it, the interest on the line is less than the interest you're earning. You keep the difference, and that is a definition of positive arbitrage. So my statement to people all the time is, or question is, if you put it in the policy and you get 6% dividends, what's your money doing? It's growing. If you then decide to access it through the bank line and they charge you 3 to 3.95, remember you're getting credited 6 and you're getting charged in the 3s, what's your money doing? Well, it's still growing. And it clicks for people. That's like when the light bulb comes on. It's like, wait a minute. You mean to tell me I can put money in this and grow it like I can any other account, get some tax benefits, that's nice, grows tax-free, 6% with guarantees. 6% these days is strong. I think by most people would agree. You can also do the index options where you can get up to 14% based on the S&P 500. But the thing is, you get this steady, consistent, or guaranteed growth. And then when I want or need to access funds, because guess what, folks? That's life, right? We have expenses, we have bills, we have things we want and need. I can access it from the bank line. It's going to cost me in the 3% range, but I'm still making the 6. So I keep the difference? I said, yep. You can make 2 to 3% return on your money still after you spend it. Now, you start to consider that and put in compound interest and understanding how compound interest over time works. The question I always ask is, do you think you'll have more money to spend in the long run if you're still earning interest on money you spent? And the answer is, of course. See, and as you spend more and as you go further along in spending more and more dollars throughout your lifetime, that gap widens and gets bigger and bigger and bigger, doesn't it? In other words, you have more and more and more money to spend, more and more money accessible to you to access and use. And isn't that the purpose of investing money in the first place, right? I mean, the ultimate goal for most people is when they invest, they put money away, They're doing it because at some point in the future, they want to have access to those dollars to spend, typically, to supplement retirement, right? It's probably the number one reason why people put money away, set some money aside. A lot of us lose sight of that. Start focusing on rate of return to maximize the growth on it and all that. And there's nothing wrong with focusing on rate of return and maximizing the nest egg. Of course, you want to grow it. But a lot of the time, the distribution plan kind of gets lost in the mix. In other words, how much are you going to actually have in your pocket when it's all said and done that you can actually spend? I spoke to a gentleman, I think a day or two ago, and he had read one of the books that I recommended. I've recommended it on the show many times. It's called The Power of Zero by David McKnight, and it talks about qualified plans, IRAs, 401ks, and the tax consequences of those types of accounts, particularly down the road in retirement. And after reading the book, he shot me an email, and we met yesterday. In fact, he says, it's very clear that I need to rethink my retirement plan after reading this book. And one of the big premises of the book is real simple. What is the tax rate going to be on your IRA or 401k when you retire? Or when you access, or maybe you are retired. What is the tax rate going to be on those dollars when you access them 5 years from now, 10 years from now, 20 years from now? Can you tell me? No one knows. Are those tax rates going to be higher? They're going to be lower. Again, no one knows. It's impossible to predict. So the point of the book is simple. He said, look, if interest, and by the way, one of the top CPAs in the country, it's Ed Slott, has written a foreword on this book. He's absolutely convinced tax rates are going to be higher in the future based on government debt and various other reasons. And the point of the book is simple. If tax rates double in the future, which, let's be honest, it could happen. It's in the realm of possibility. Well, if tax rates double in the future on your IRA and 401k, 2 times 0 is still 0, isn't it? In other words, if you structure a tax-free income, a tax-free plan, then irregardless of what the tax rates are in the future, the brackets and income, whatever it is, doesn't affect you. It doesn't really matter, does it? That's why they call it the power of zero. 2 times 0 still equals 0. So if you don't have a tax plan in place for your IRA, 401k, retirement type of accounts, I strongly recommend you contact us at yourpersonalbank.com. I'll be happy to talk to you about it and show you how to structure a plan that can help create tax-free income, much like the book talks about, The Power of Zero. And we can add to it, taking it to the next level by adding the bank line of credit. So not only we can grow your money tax-free, show you how to access it tax-free, and on top of all that, earn interest, positive arbitrage on those dollars that you spend, which ultimately means if you're paying less tax, you're going to have more in your pocket, right? And if you're still earning interest, you're getting a positive arbitrage on dollars you spend, you're going to have more money to spend in your lifetime. In other words, your money's going to last longer, and you'll have more of it to spend in retirement. And isn't that the ultimate goal? As always, stay tuned to the Your Personal Bank show on Money Radio. We're on every Tuesday at noon and Thursday at 1. And you can always contact us at yourpersonalbank.com. Look forward to talking to you next week.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and bank line of credit rates may charge. Contact yourpersonalbank.com for current rates.